It's a Friday evening in Dubai and you're getting ready for dinner with friends. Just then, your phone buzzes. Notice from the Income Tax Department, Government of India. At first you think it's spam, but then you see your PAN number in bold and you start to worry about the consequences. In the last few years, there has been a spike in NRIs getting tax notices. In fact, there was a 340% surge in tax notices issued to NRIs in 2024 compared to 2022. And in most cases, it happened not due to fraud or corruption, but simply due to missed filings, mismatched TDS entries, or undeclared Indian income. And what's worse, nearly 70% of these could have been avoided with a few simple steps. Although the government introduced the new tax bill in 2025 with the aim to simplify taxation for all. But if you are an NRI, the bill with its 536 sections and 23 chapters is still overwhelming. But don't worry. Today, I'm here to discuss 6 golden rules that will answer all your questions and doubts about NRI taxation once and for all. Welcome to NRI Shala. I'm Malvika, and this is where we simplify life abroad, from finance and taxation to the small decisions that make a big difference. Before anything else, the very first question about taxation begins with clarifying whether you are even an NRI or not. But why does this matter? Because your residency decides what India can tax. So you are an NRI if you've stayed in India less than 182 days in a financial year, or less than 60 days in the current year and less than 365 days in the last 4 years. Seems simple, right? But there's a catch. If you're earning over 15 lakh rupees a year from India and you spend more than 120 days in India, you will be considered a resident for tax purposes. Let's understand it with the help of an example. An NRI who was working as a software engineer from London decided to work remotely from Bengaluru for 5 months, while he thought he was an NRI who just stayed in India for a few months. India's tax rules said otherwise. He stayed for 150 days in India, plus his 20 lakh rupees Indian income gave him a resident status. And the result? He was liable to pay taxes for this income in India as well. So while Indian residents are taxed on their global income, NRIs are only taxed on income earned or accrued in India. Income earned in India is money you actively make through work or services here, like salary from an Indian company, profits from a local business, or fees from Indian clients. On the other hand, income accrued in India is money that's due to you from Indian sources, even if you haven't received it yet. For example, interest accumulating on your NRO deposits, dividends from Indian stocks, or rent that's due from your property back home. The key takeaway here is always keep a record of your days spent in India. Even a single flight date can change your tax status, so you can end up getting a tax notice. You'd be surprised to know that most tax notices to NRIs don't come because of fraud, but because of one simple misunderstanding. I already pay tax abroad, so why bother about India? And that's where most of them go wrong, because the rule is simple. If your income originates in India, even if it's transferred abroad or credited to a foreign account, it's still taxable in India. These are the 4 basic types of incomes you need to declare. The first is rental income. Many NRIs own properties in India, and any income generated from renting them is taxable in India, even if it's directly credited to your NRO account. The tenant must deduct 30% TDS before paying rent. Although you can claim 30% standard deduction, home loan interest, and property tax to reduce your tax liability. Then comes undeclared interest income. Any interest earned on your NRO account, fixed deposits, or even dividends from Indian shares or mutual funds is fully taxable in India. Your bank automatically deducts 30% TDS when crediting this interest. Even if it's a small FD earning 10,000 rupees, it counts. On the other hand, interest earned on NRE or FCNR accounts is tax-free. Many NRIs ignore small FD interests and end up getting notices. The third kind of income is business or professional income. This is another often overlooked one. If you run a business in India or provide freelance or consulting services to Indian clients, that income is also taxable in India, even if the payment goes into your foreign account. So if you're coding for an Indian startup while sitting in London, India still gets a piece of that pie. Now comes the most crucial category, income from capital gains. Whenever you sell an asset in India, it could be property, shares, or mutual funds, the profit you make is taxable. Firstly, selling a property. If you sell it after holding it for more than 24 months, you attract a 12.5% long-term capital gains tax. And if you sell it within 24 months of acquiring it, you are taxed 30% short-term capital gains tax. But you can claim capital gains exemption under Section 54 or under Section 54EC by following the conditions and timelines to get these benefits. Secondly, selling shares or mutual funds. If you sell shares or mutual funds within 12 months, it is considered short-term capital gains and taxed at 15%. Also, they are subject to TDS at the same rate. While those hold for over 12 months and are treated as long-term capital gains, they're taxed at 12.5% without indexation on gains exceeding 1.25 lakh rupees. Here too, the broker deducts TDS upfront. Even in this case, if you reinvest your gains under Section 54, you can avoid paying capital gains tax altogether. So before you sell, consult a CA and save big on taxes. There's one big myth among NRIs. TDS is already cut, so I don't need to file returns. But filing ITR isn't just about paying tax. It's how you claim refunds, avoid penalties, and build your financial credibility. See, the tax department deducts TDS at the highest possible rate for NRIs because it's difficult for them to recover dues from someone living abroad if they undercharge, which means in most cases you've paid more than what you owe. So you must still file your income tax return and get back the money you deserve. Let me explain this with the help of an example. You sell a property for 1 crore rupees. The buyer deducts 12.5% TDS on the full amount, that's 12.5 lakh rupees. But your actual profit is only 30 lakh rupees. So your real tax should have been 3.75 lakh rupees. That's 8.75 lakh rupees stuck with the government. And the only way to get it back is by filing your ITR. Not only this, your ITR is proof of your financial credibility. Banks, embassies, and visa authorities often ask for it. So remember, TDS isn't the end of taxation. It's just the beginning. File your return, claim your refund, and keep your record clean. Apart from tax benefits, there are certain other conditions under which NRIs must file ITR, and avoiding to do so is a sure way of getting a tax notice. These are some key cases where NRIs must file their ITR. The first one, if your total taxable income in India exceeds 2.5 lakh rupees in the old regime or 4 lakh rupees in the new regime. The second one, if you deposit above 50 lakh rupees in savings accounts or 1 crore rupees in current accounts in a financial year. And third, if you have spent more than 2 lakh rupees on foreign travel in a year. And the fourth, if your total TDS or TCS exceeds 25,000 rupees in a year. And finally, if you pay more than 1 lakh rupees annually on electricity, it also triggers the requirement to file. Now that you know what to file and why, let's talk about what every NRI truly wants to know: how to save taxes legally. The first decision, choosing between the old and the new tax regime. Under the old tax regime, you get zero tax up to 2.5 lakh rupees, while the new regime raises that limit to 4 lakh rupees. The rule of thumb says, if your income is on the higher side, the new regime's lower slabs may work better. But if you actively invest in ELSS, NPS, insurance premiums, or even home loan EMIs, the old regime gives you more deductions under Section 80. Next, while NRIs are taxed at the highest rate for TDS, there is a way to reduce it. Apply for a lower TDS certificate under Section 197. Just fill Form 13, share your expected income and documents, and the income tax department issues your certificate. This tells your tenant, buyer, or bank to deduct tax at a reduced rate as mentioned in the certificate. It's legal, simple, and can save you lakhs. You can also reduce your tax burden through smart investments. For instance, invest in ULIPs. These do have a lock-in period for 5 years, but if your annual premium is below 2.5 lakh rupees and is within 10% of the sum assured, you pay zero tax at the time of maturity. Or you can also invest in your PPF account, where if you invest up to 1.5 lakh rupees per year, the entire maturity amount, along with earned, is completely tax-free. But remember, as an NRI, you cannot open a new PPF account. However, you can maintain your existing one. But wait, there's a hidden tax most NRIs miss when making these investments. To fund your PPF or pay your ULIP premiums, you have to send money from abroad to your Indian account. Most traditional banks and apps charge a hidden markup of 2% to 3% on the exchange rate. You're trying to save tax to maximize returns, but you lose money just moving it there. This is where I use Aspora. Aspora gives you the exact Google exchange rate with zero hidden markups. So if you send 1.5 lakh rupees for your PPF or any other investments, the full value reaches India, not a penny less. Check the link in the description to try Aspora for your next transfer. Because in the end, it's not just about earning more, but also keeping more of what you earn. And finally, something that confuses even the most financially savvy NRIs. What if I'm taxed both abroad and in India? Let's take an example. Say an NRI living in the US earns 12 lakh rupees in a year through dividends from Indian companies and interest from his NRO deposits. Under Indian law, this income is taxable here. TDS is automatically deducted before it even hits his account. But since he's also a tax resident of the USA, the same 12 lakh rupees falls under American tax rules too. Essentially, he's being taxed twice on the same income. That's where DTAA, or Double Taxation Avoidance Agreement, comes in. By submitting a Tax Residency Certificate, or TRC, Form 10F, and proof of taxes already paid in India, he can avoid paying tax again in the US and save nearly 5 lakh rupees in duplicate taxes, all legally. India currently has over 94 comprehensive DTAAs and several limited ones, each outlining how income should be taxed and credited between countries. So if you are living in a DTAA country, check your treaty benefits every year and save yourself from dual taxation. The truth is, taxation for NRIs isn't complicated. It's just different. And the good news, you don't have to fear it if you understand it. So remember these 6 golden rules. Know your residency status. Declare every rupee earned in India. File your ITR and get back what's rightfully yours. Know when filing becomes mandatory. Save taxes the smart way. And make the most of DTAA to avoid double taxation. Because the goal isn't to outsmart the tax system. It's to understand it well enough that it never catches you off guard. For NRIs, awareness isn't a choice. It's what protects your money, your peace of mind, and your future. I'm Malvika, and this is NRI Shala, where we make life abroad a little simpler. Hit the like and subscribe button if you found the video useful. I'll see you in the next one.